Welcome to the Deep Dive. We're here to cut through the noise and get you the core insights.
And today, we're digging into an earnings call transcript you sent over RCI Hospitality Holdings, their second quarter for fiscal 25.
Yep. Our goal here is simple. Unpack the key numbers, what management said, their plans for the future, all based only on the material you shared.
Exactly. Think of it as getting you up to speed quickly on what RCIH discussed this quarter. No fluff.
Right. Let's jump straight in. Top line figures for the quarter ending March 31st. Total revenues clocked in at $65.9 million.
Now, that is down from $72.3 million the same time last year. So, a noticeable drop.
Okay, so what did management say caused that dip?
Well, they pointed to mainly two things. First, they sold off or divested 5 Bombshells spots they felt weren't performing well. That took a chunk out. Second, they talked a lot about severe weather, caused closures, slowed things down, especially back in January, February.
Right.
Places like Dallas and Houston really felt it. They did say things picked up a bit in March, though.
Okay, so revenue's down. But here's a twist, looking just at the headlines. Net income for common shareholders actually went up. Quite a bit, too. $3.2 million this quarter versus only $0.8 million last year.
Yeah, and GAAP EPS, the earnings per share number, jumped from 8 cents to 36 cents. Looks great on the surface.
So what's the story there? Better operations?
Actually, no, not really, based on this quarter's sales. This is where digging in helps. That big jump, it was almost all because of lower impairment and other charges.
Okay, like write-downs.
Exactly. Think of them as accounting charges for assets not doing as well as hoped. Doesn't always hit cash flow right away. This quarter, those charges were $2.1 million. Last year, they were a hefty $8.2 million in the same period.
Wow, okay.
So that's $6 million plus difference in non-cash charges. It basically wiped out the negative impact of lower sales on the official GAAP profit number. The accounting looked better, but the core business faced headwinds.
That's a crucial distinction. So the GAAP profit improved mainly because last year had those big write-downs. What about actual cash generation and the non-GAAP numbers they use?
Good question. Net cash from operations was $8.5 million. That's down a bit from $10.8 million last year.
Okay.
They linked that mostly to lower operating margins because, well, sales were down. Free cash flow, that's cash from ops minus capital spending, was $6.9 million, down from $8.8 million.
And adjusted EBITDA?
Adjusted EBITDA came in at $14.2 million compared to $17.2 million last year. And their non-GAAP EPS, which adjusts for things like those impairment charges, was 65 cents. Last year was 90 cents.
So those numbers, the cash flow, the adjusted figures, paint a slightly less rosy picture of the quarter's operational performance compared to that headline GAAP profit.
Precisely. It shows the impact of those lower sales more directly.
Okay, super helpful context. Let's pivot now and look at the two main business segments, starting with their core, the nightclubs.
Right. So nightclub revenues were $57.5 million. That was down about 3.1% from last year.
And the reasons they gave for that specific decline?
Couple of things. Same-store sales, so sales at clubs open for comparison, were down 3.5%. Plus, they didn't have the revenue from the Baby Dolls Fort Worth Club because of that fire.
Ah, right.
But offsetting that a bit was the contribution from Flight Club, the place they bought in Detroit, that added about $1 million. And they had 4 rebranded clubs that aren't in the same store comparison yet. They also gave some interesting color on the mix of sales inside the clubs. Alcohol sales down 5.3%, service revenue down 2.9%.
Okay.
But food, merchandise, and other stuff actually increased 2.4%.
So maybe fewer big spenders on bottle service, that kind of thing.
That's what it suggests, yeah. Maybe traffic held up okay, but the average customer spend, especially on the high-ticket items, might have softened a bit. It's something to watch if you're following them.
Interesting. Now, profitability in nightclubs. The GAAP operating income margin looked amazing, jumped from 8.6% last year to 25.4% this quarter.
And here we go again with those impairments. Yes, the GAAP number looks fantastic, but the non-GAAP operating margin for nightclubs was actually a bit lower. It was 29.8% this quarter versus 33.4% last year.
So that huge GAAP jump is almost entirely because last year's number was weighed down by big impairment charges in this segment.
Exactly. It wasn't about a sudden surge in operational efficiency this quarter compared to last year. It was mostly about the absence of those large non-cash charges hitting the books.
Okay, that makes sense. That's the game plan for the nightclubs moving forward. based on what they said?
Well, they're constantly looking at the existing clubs, trying to boost those same-store sales. If a club isn't performing, they'll look at rebranding it, changing the format, or, even selling it off.
And acquisitions.
Oh, yeah, acquisitions are still a huge focus. They're targeting adding about $6 million in adjusted EBITDA per year through buying clubs, and they have specific financial targets for those deals.
What kind of targets?
They're aiming to pay around 3 to 5 times the club's EBITDA, plus the fair market value for any real estate involved. The goal, they said, is to get a 100% cash-on-cash return within 3 to 5 years.
Meaning they expect to get their initial investment back that quickly.
That's the target, yeah. It shows you the kind of returns they're looking for. They mentioned they just closed 2 deals, Flight Club in Detroit, Platinum West in South Carolina, and they're already working on another one.
Okay, solid strategy there. Let's switch over to Bombshells. That segment had a much bigger revenue drop rate.
It did, yeah. Bombshells revenue was $8.2 million. That's down 35.6% year over year, a pretty steep decline.
And the drivers there, similar story.
Partly. Remember those 5 locations they sold off? That accounted for $3.7 million of the drop right there. Then same-store sales for the remaining Bombshells were down 13.4%.
Ouch.
Yeah. And like the nightclubs, the bad weather hit Bombshells too.
And profitability took a big hit too. I saw they reported a loss in this segment.
Correct. An operating loss of $227,000. Last year, they made about $700,000 in income in the same quarter. So the margin went from positive 5.5% to negative 2.8%.
That's significant.
It is. And management made a point of saying this was the first quarter Bombshells ever lost money since it started, like 14 years ago. They pinned most of that loss on startup costs for the new Denver location that just opened.
Wow, first loss ever. That really highlights the challenges this quarter. So what's the plan for Bombshells now?
The focus is on improving the existing locations, get those operating margins back up towards 15%, and get same-store sales growing again. They also want to finish building the 2 new ones already in development.
Okay.
But they were also pretty candid. They acknowledged the whole restaurant industry is tough right now. And interestingly, they said they'd be open to selling the entire Bombshells segment if the right offer came along.
So they're keeping their options open there. That tells you something about their priorities. Okay, let's look at the overall financial health. Balance sheet, capital allocation.
Sure. End of the quarter, they had $32.7 million in cash. They did spend about $6 million of that on the Flight Club acquisition, and another $2.9 million buying back their own stock.
And what about debt? Did that change much?
Debt went up by about $5.9 million from the previous quarter end. Most of that was tied to financing the Flight Club deal and paying for construction on the new Bombshells in Rowlett and Lebec. They did make their regular scheduled payments, which offsets some of it.
Interest rates holding steady.
Yeah, the weighted average rate was pretty stable at 6.7%. They also talked about their debt to EBITDA ratio. It ticked up slightly to 3.56 times from 3.32 times.
Which makes sense given debt went up slightly and the quarterly EBITDA was lower.
Exactly. Management expects that ratio to come back down as sales hopefully recover with better weather and the new locations start contributing.
And they laid out a longer-term plan for using their cash, right? Over the next 5 years.
They did. A pretty clear 5-year capital allocation strategy. The plan is to put 40% of their free cash flow towards buying more nightclubs. And the other 60%, that's going towards a mix of buying back shares, paying down debt, and dividends. The big goal behind all this is to grow free cash flow per share by 10-15% each year.
And they've been active on buybacks already.
Oh, yeah. They highlighted they've reduced their share count by about 15% over the last 10 years, down to around 8.8 million shares now. And they expect small, steady dividend increases too.
Did they put any specific targets out there for the end of that 5-year plan, say fiscal 2029?
They sure did. Aiming for over $400 million in revenue by then, generating $75 million in free cash flow, and getting the share count down further to 7.5 million shares.
So if you put all that together.
Yeah, the goal is basically to double free cash flow per share from where it was last year, aiming for around $10 per share by fiscal 2029.
Well,
ambitious targets for sure, gives you a clear sense of their direction.
Okay, what about updates on all the construction projects they have going on?
Right. They confirmed 2 new spots are now open, Bombshells Denver and Chicas Locas in El Paso.
Good progress.
And they have 5 projects still in the works. 3 are apparently getting close. Bombshells Loveland and Rick's Cabaret Central City are aiming for late May, early June openings. Bombshells Rowlett, maybe sometime this summer.
What about the others?
Baby Dolls West Fort Worth is still waiting on permits. And the site of the Baby Dolls Fort Worth that burned down, they're still working through plans and zoning for that rebuild. They also mentioned selling off some properties. sold a rural site in Colorado meant for a Bombshells, lifted properties in Austin and Huntsville also originally for Bombshells, for sale or lease, and the closed Grange property is still up for sale.
So optimizing the property portfolio too.
Seems like it. Cleaning things up, focusing resources.
Any other initiatives they touched on?
Yeah, briefly mentioned Favoritely.com. That's their fan site for entertainers. It said it's out of beta now, and they're adding more clubs and entertainers to it. And they gave some thoughts on the macro picture. They believe a lot of their high-end customers, the big spenders, are small business owners.
Okay, interesting angle.
And they feel that group spending is really sensitive to economic uncertainty. So they're hoping if things feel a bit more stable, maybe a clearer tax situation, gas prices staying reasonable, that could boost confidence and get those customers spending more freely again.
That connection between small business sentiment and their specific customer base is quite insightful. Okay, let's shift to the Q&A part of the call. Listeners asking questions directly usually get some good nuggets there.
Absolutely. One interesting bit was about financing costs for acquisitions. Someone asked about rates.
Yeah?
Management said seller financing and bank loans are running around 6-7% right now. The caller remarked that's like a 30-year mortgage rate. And management basically said, yeah, that's about right for the current market. They also talk about how the acquisition market itself has changed. Remember those sky-high numbers from 2022?
Oh.
Well, management's saying sellers who want valuations based on those numbers are now having to get more realistic, maybe average things out, because 2024 has been, in their words, a bad year for the industry generally. Many others saw steeper drops than RCIH did.
So RCIH feels they can be patient?
That was the message. They're not rushing. They'll only do a deal if the terms fit their model and return targets. Also, a little tidbit on who's selling. They said most owners they talk to are, late 60s to early 80s. An aging ownership base.
Makes sense. Creates opportunities.
Right. But they also see some younger owners, maybe in their 40s, looking to get out, possibly for lifestyle reasons, marriage, family, that sort of thing.
Yeah.
There was quite a bit on Detroit and the flight club they bought there. Management sounds really positive about that market.
Despite some initial challenges.
Yeah, they mentioned dealing with rumors and the bad weather right after they took over. But things have apparently improved a lot since. The biggest change they made, focusing on treating all guests well, making sure the average guy feels just as welcome as the VIP spending big money. Apparently, the previous owner was more focused only on the high rollers. They also said they're looking at other clubs in Detroit, even floated the idea of something on 8 Mile.
Okay, interesting. What else from the Q&A?
Someone asked about the insurance accrual number. Management clarified it's about $1.3 million per quarter, part of an $8.8 million estimated annual run rate. And importantly, it's a non-cash charge on the books, an accrual based on estimates, not necessarily cash out the door each quarter.
Good clarification. Did they try to put a number on the weather impact?
They did try. Estimated it cost them about $700,000 a week in sales for roughly 8 weeks. So maybe $5.6 million in lost sales total.
And the profit impact.
Potentially $3 million or more in lost EBITDA, since costs don't just disappear when sales drop. They specifically said Q3, the current quarter, should be much cleaner without those major weather hits, a better baseline to judge performance. And finally, they circled back to industry headwinds, reiterated the restaurant side is tough, even mentioned competitors like Twin Peaks might be seeing negative same-store sales.
And on the club side.
Headcount seems okay, but spend per person is down.
Yeah.
Especially the big ticket stuff, bottle service, pricey liquor. Again, they link that to economic uncertainty hitting their small business owner clientele. Though they did say specific events, like the Knicks playoffs in New York, can still give certain clubs a nice boost.
Okay. Now, there was a question during the call about something called Project 2025 and potentially outlawing pornography. How did they handle that?
Right. So management's direct response on the call was that they hadn't heard anything about that specific issue.
Oh.
They then made it clear they don't view themselves as being in the pornography business, emphasizing they don't make videos. They pivoted to talking about their anti-human trafficking work.
How so?
Mentioned being a founding member of Coast Club Owners Against Sex Trafficking, and that their training program got a congressional honor. They also cited studies suggesting, they said, that less than 0.1% of human trafficking is linked to adult clubs.
And just so everyone listening understands, we are simply relaying what management said in response to that question based purely on the source material you provided. We're not taking any sides or endorsing any views here.
Exactly. Neutral reporting of the call content. Okay, let's shift gears now into our segment. This is not financial advice.
Absolutely, because after hearing all that the weather effects, the divestitures, the acquisition strategy, the long-term goals, the struggles in Bombshells versus the relative steadiness in Nightclubs, the customer spending sensitivity, the Q&A details, it definitely gives you, the listener, a lot to chew on.
Yeah, based purely on what was said in the call, you've heard management expects a Q3 rebound as weather clears. They're focused on buying clubs, meeting specific criteria, trying to fix or potentially sell Bombshells, and aiming for those big 2029 targets.
You also heard their perspective on current challenges and how they plan to navigate them.
But remember, and we have to say this very clearly,
this discussion is strictly informational, based only on the earnings call materials provided. It is absolutely not financial advice. Don't make investment decisions based on this conversation. Do your own research. Talk to a professional advisor.
Right. We've just laid out the map according to management's commentary. You heard the path includes navigating some headwinds while pushing forward with their strategic plans.
So quick recap. We dove into the RCIH Q2 earnings call. Saw revenues hit by weather and divestitures, but JAP profit boosted by lower impairment charges compared to last year.
We looked at the core nightclub segment. Steady but seeing some spending shifts, with growth focused on acquisitions, and the Bombshells segment facing real challenges, leading management to consider even selling it.
We covered their financials, their 5-year capital plan, emphasizing buybacks and acquisitions, updates on new locations, and key points from the management Q&A.
Pulled out the key numbers, strategies, and comments directly from the source material you gave us, aiming to get you informed efficiently.
So as you think about RCIH based on this call, maybe the lingering question is this. Given the tough environment they described, especially for restaurants, and the softer spending per person in clubs, can their specific company actions, buying clubs carefully, opening new spots, potentially selling Bombshells, really drive enough growth to hit those ambitious 2029 targets if the broader economy doesn't significantly improve? Something to ponder.
We certainly hope this deep dive was useful. Again, it's all based on the source material provided, purely informational, definitely not financial advice.
Thanks for sharing the sources and for tuning in. Let us know if you have other materials you want us to tackle. Until next time.